Good morning. Today we will continue to reflect on the fallout following the collapse of Silicon Valley Bank and what the market impact has been over the last 24 hours. Yesterday we heard from Kevin Kidney, who summarised the events that have taken place regarding Silicon Valley Bank. Over the last 24 hours, we've seen a pickup in market volatility. It's important that we've seen the US regulator really step in and ensure and guarantee all US deposits within all banks across the United States. Over the last 24 hours, we have seen a spike in volatility in financial markets. We've seen financial conditions tighten. When we look at market returns, over the last 24 hours, we've seen weakness within European, UK and Asian equities. We've seen US equities fare better, with the S&P 500 only down marginally, minus 0.15% on the day. The Nasdaq was actually up 0.45%. So there is a bit of dispersion there. When we look at sector performance, we also saw dispersion where defensive sectors such as healthcare performing better, and unsurprisingly we saw weakness within the banking sector. When we look at government bonds, we actually saw government bonds rally. Yields fell and bond prices rose. We actually saw the biggest gain within the US market on the 2-year US Treasury bond, falling the most, or the yields falling the most in over 40 years, which means prices rise as investors really seek safe haven assets. We saw gold perform well. Really what's behind the moves is market expectations for interest rates have actually changed materially. This time last week, the market was expecting interest rates to go from 4.75% to nearly 5.7% over the next few months. That's all changed. The market now believes that the US is done in raising interest rates going forward, and actually it's expecting interest rates to be cut as we progress throughout the year, getting to around 4% by the end of this year. So a big change in interest rate expectations, and therefore we've seen that impact bond prices, which have gone up. In terms of why this all matters to investors, really over the last 18 months, you'll have heard from us talk about weakness in government bonds as they've digested higher inflation, higher interest rates. But in times of a spike in volatility, investors actually rush to government bonds, and that's why they play an important role within multi-asset portfolios. In terms of what this also means for investors is that if interest rates are no longer going to go up in the US, that means mortgage costs are likely to come down sooner rather than later. And it also means that the cost of borrowing should also ease, important for households, but also corporates. In terms of what to conclude, well, really we do expect volatility to remain over the short term as things continue to unfold for SVB and the banking sector more broadly. But what we're seeing in financial markets is it's really appropriate to be diversified, and that's why here at True Potential we manage clients' investments by being exposed to global assets, being exposed to equities, bonds and alternatives. That's all from us today. Thank you for listening, and we'll see you tomorrow.